So basically, the whole IV thing, the reason we're bringing it up is because we want to go over criteria that we look at and what we like when it comes to IV. Because when it comes to option IVs, it's very important to look at that factor or that option strat or stat when you're swinging, right? Because you don't want to be put in the wrong situations, and you can actually take advantage of option IV. So before we go over, what I look at, where JP looks at, I would like JP to give a very simple meaning. And I'm sorry, JP, I'm making you repeat this, but yeah,
Yeah,
go ahead.
I'll explain it as simple as possible. So basically, implied volatility measures um, how much the market expects a stock price to move, let it be up or down. And the way that I always say it is basically it's like a prediction of how unstable price might get. Um, and there's only like really like 4 points that you can use to kind of understand how IV works. And basically, like a higher IV normally means that there's going to be a bigger price swing on that particular underline, which means that it's going to be more, there's going to be more uncertainty. And lower IV means the complete opposite, right? Lower IV means that, that you're expecting a smaller price swing and it's going to be more stable. But one of the key factors to always know is that when there's high IV on options, it normally means that they're more expensive. And when there's low IV, it tends to mean that options are cheaper. So those are like that's the simplest way to explain it without going down, the rabbit hole.
Yeah, exactly. The thing about IV is you can actually make it, you can take advantage of it, right? And we're gonna go over a few things. So if I sound out of breath, I just ran up and down the stairs. But if so, on Webull, I know a lot of people don't have Thinkorswim. I'll say it again. I think Thinkorswim is the best trading platform out there. Reason, Schwab sucks, but reason is because the platform itself of Thinkorswim, the fills are amazing. A lot of things are available to you as tools, data. It really helps you out, right? So we're gonna go over. I got a question. It says how much IV can we consider high and low, and that's the main thing we're actually going to be going over because for each stock it's different. Because each stock moves differently, just as JP said, right? It kind of measures the movement of a stock, right? High IV means the stock moves a lot. Low IV means typically stock moves not as much. But so on here on the left side, and I think you guys can see it clearly. Yes, you can. Um, so on here on the left side is my phone, and I'm sharing my screen. I don't use Webull, but again, unfortunately, Thinkorswim is down for maintenance since it's Saturday. So a great thing you can see is when you go onto NVIDIA, for example, because everybody knows NVIDIA, you go over to the options, right? So what you could see here on the top, yeah, let me see if I can show my mouse. So you can see here the implied volatility is 37.54, right? Um, if you it shows my text as well. If you can't really gauge if okay, is this IV too high or is this IV too low? So the great thing is if you actually press this arrow right over here, this interesting thing comes up where it shows on the bottom the implied volatility currently is 37.54, right? There's a little description over here, but basically what it shows here is two different numbers, right? The 52-week IV low and the 52-week IV high. Theoretically, if a stock is trading at its near its 52-week IV high, the contracts are going to be very inflated, and for those contracts to work favorably on your side if you're buying them, the stock has to move a significant amount. But if the IV is lower, and let's say it's near its lower mark, then the stock does not have to move as much or strongly for the contracts to gain value because the contracts are not inflated in price. So it's very important to look at this factor because if you have a stock like Nvidia, just to let you know, the IV was a lot higher, especially when we were at all-time highs. A few days ago, actually, the IV was near, I think, close to 50% or 40%. I forgot what it was. But when there's a lot of momentum happening, the IV is going to be very substantial. And you don't want to, the whole point of buying options is you want to buy at a cheaper price and sell it at a higher price, right? So if you buy a contract that's already priced very high and you get a movement that you want but not as strong as the IV wants it to be, if that makes any sense, then the contracts are just they just don't make sense. So a lot of times, you hear about like, oh, I was in this trade but the contracts didn't move. Majority of the times the biggest factor is if those contracts aren't being spoofed around, meaning like there's not, a person, a hedge fund or a whale just messing around with the contracts. Usually it's because the IV is not on your side. So theoretically, let's say you would be Nvidia contracts, you get Nvidia puts, right? And let's say the IV is very high. Next day it gaps down, but you're only up like 10 or 20%. And you're like, oh, wait, why is it only up this much? Well, it's because the IV is so high. You didn't get a strong move to the downside, right? You got a decent or a small move. And because the IV is so high, the prices of the contract is so inflated that it doesn't theoretically make sense to actually even trade that setup. Well, then what would be favorable? Well, the favorable thing is, let's say if you see a setup on Nvidia, let's say Nvidia comes down to 139.78 and you see a bounce and you're thinking, okay, let me get calls, right? And the IV is around 37.54 where it is right now or lower. The great thing is, let's say Nvidia bounces very strongly off of 139.78 and it, just propels into the upside. As we stated before, the IV of the contract or the IV of the option chain in general for Nvidia will increase a lot. And as we stated before, since IV inflates the contract prices, not only will you be gaining from the contract price of gaining because the price is going up, but also because the IV is racking up, so the contract price gets inflated, right? So just similar as you want to buy a contract when it's cheap and then sell it when it's higher, it's somewhat the same way with IV when you're buying contracts, right? You want to buy at low IV and you buy at high IV. Now, when it comes to reality, the reality is you're not always going to find yourself in situations where you're going to have the lowest IV on the contracts and you get in and you get that amazing rally up, right? That doesn't always happen because right now the market we are in is a very high volatile market. So the 52-week low, like 20%, 20.85% on Nvidia, we're not going to see that for a while, right? That's just not going to happen because when that was happening, that was like all the way in January, when things were just starting to ramp up and stuff like that. But what you can try to always check, right, is if the contracts are at least in an average IV. That is something I always look at. That's why I don't always trade high volatility stocks like Coinbase and Mara, right? Those are two great stocks to like either make a lot of money or lose a lot of money because a lot of the times, and I'll go over to Mara and Coinbase right now, a lot of the times the the IV, the normal IV on these contracts are very high. So if I look at it right now, you can see the implied volatility is 115%. That already tells you, okay, I need to get a really strong move on Mara for my contracts to work out. Let's see the range of the IV for the contracts. You could see the 52-week low is 84%, and the 52-week high is 189%. It is currently above the median or above the average, right? You're above you know, the standard or the middle part where it's average enough where it's okay, it's reasonable. And the great thing is it also shows the historical volatility. So you could see the HV percentile we're in right now is so much higher than what Mara has been, right? The lowest was 51%. We're at freaking 149, which is close to the 52-week high. So is Mara a great stock to swing trade? Maybe. If you got the money and you just want to, hey, I want to buy a few contracts. I don't care if it goes to zero or I don't care if it loses 50%. Sure, you see a setup? Great, but have the realistic expectations, right? If it moves, yes, it will move. But if it doesn't move, the IV will work against you because you're not getting your movement, and on top of that, the stock is not moving is not moving as much in your favor, right? So you have two factors working against you. Versus, let's say if this, if, let's say in another world Mara had lower IV, even if the price went against you, and let's say you bought calls and price goes against you, yes, IV will work against you, but at a limited fashion. Sorry for lack of better words, but in a limited way, right? It's not as strong versus in the current state of Mara. If it works against you, you're like, if it even gaps down, let's say you buy Mara calls and Mara gaps down like even 0.5%, and the next day the contract's open, you're looking at your contracts losing like 30 to 40% value, depending on the expiration, of course, right? So it's just something to keep an eye out. Like I'll show Coinbase really quickly. I'll show a few examples because it's very important to keep an eye um, on this, right? So implied volatility for Coinbase 88, lower than Mara, correct? So let's go into this. Oh, by the way, I'm pressing this arrow right over here if you guys can't see it. So you press this arrow, you scroll down, you could see Coinbase 88% volatility. Where is it? It is so close to its 52-week high. And you can see historical volatility is 92% rank, which means it's so close to its 52-week historical. Like, it's crazy, right? So that's why sometimes when you trade these stocks like Coinbase, Mara, right? If it goes, it goes, right? These contracts like increase even more in value because there's IV on your side. But when it goes against you, it kills you. So it's something to keep an eye on. A few examples I'll show. Tesla, right? And I'll get into Meta and why Meta, I can't really do Meta Fridays as much anymore. So we'll go into Tesla over here on this dumb little Weeble app. If you guys don't know, I don't like Robinhood and Weeble. I think they're scams, but anyway, that's a discussion for another day. Uh, Implied volatility. I don't need to even say more. Why is the IV so high? As JP said, when a stock moves and the predicted stock move is going to be higher, of course the IV is going to be higher. And the implied volatility on Tesla is 69.53, which is so close to its 52-week high. That means if the contracts don't move in your favor, you're going to be screwed, right? Those Tesla calls we took on Monday, well, actually on Friday and on Tuesday or Wednesday, if they didn't work out, that's why I size light. I size lights for a reason, because if they didn't work out, I'm going to lose a substantial amount from those contracts, right? If I, that's why sometimes if you're in these situations where you want to trade a stock and you're trading, let's say, that sector, sometimes the best thing you could do is go with a sympathy trade. And for Tesla, that sympathy trade would be ARK, because ARK does own a majority of Tesla, right? So let's say if Tesla gaps up on Monday, since we got ARK calls on Friday, ARK will gap up as well. And if we go to ARK options chain, yes, it will be higher because, of course, Tesla has been gapping up. So, this is obviously getting impacted as well. But at least the IV percentile is lower than what Tesla was, because I believe Tesla was like 80 or 90%. And historically, it's not too bad. It is bad, but it is too bad. So even though there is risk on this trade, and again, if you go back to the trade I posted for ARK, I did size light on this compared to my other trades because the IV is high. So it's good to look at this, right? And then the last example I want to show, actually two more examples, is Meta. So the reason why I probably won't be doing Meta Fridays as much anymore is, I'll show you why. Similar to Tesla. Damn. Okay. Well, even though this is lower, even though this is lower, during this rally over here, and I need to delete all these levels, during this rally over here in early this week, the IV was 50%. It was 50 or 40%. It was like 45, 40, 50%. It was all the way up here. So that's why you would see all these Twitter posts and all these people saying, "Oh, meta contracts are so expensive," because the IV was insanely high. Not until we started getting this a little bit of consolidation and chop, the IV reduce to its natural state. So if it keeps up like this, then meta would be tradable, right? But if it doesn't, then I mean the contracts are just going to increase in price. Like this is next week's contracts, and you're seeing 890. Yes, it is because the price is getting more expensive, But IV, if let's say Monday comes and this gaps up to 640, the IV is gonna go from 29% all the way up to like 40% or 35%. Um, and then the last example I want to show is historically low volatile stocks, such as Coca Cola. And damn, I didn't know Coca Cola had a bad Friday. But if I search up Coca Cola over here, bring that up. Option chain. You could already see implied volatility 16%. Slow moving stock, right? So what's great about slow moving stocks? If you could find it in a place where it is above its average, right? You could say the middle, it's a little bit past that. But if you can find this stock at a really important level, and let's say you want to buy calls on it, and you think after doing your research, your own research, you think this can move very strongly, and the IV is low, if you were to theoretically buy those calls and you get the move you want, not only will you have your contracts moving for you in the right way because of course the price is going your way, but since the IV will increase because of the strength of the movement, your options benefit a lot more. So that's why you've seen a lot of my trades recently have been away from tech stocks because as you can see, the average tech stock has very high IV, such as Tesla, Meta, Nvidia, right? They have higher IVs, or historically, or in their range, they're pretty high compared to all these other stocks, like Coca Cola. What were the other stocks we traded? Um, I'm blanking out, but you know what I'm talking about. So that's the whole thing about when it comes to IV. JP, did you want to add anything to this?
Nothing. You're hitting it right on the nail on the head.
Okay, so um, you guys can feel free to ask questions because high IV or IVs in general, when it comes to options, it is a little bit about a complicated subject. We could dive in more about the deeper meanings of IV and how it really affects option price. One question that I want JP to answer because he'll give a better answer than me is IV crush. So I'll give my very simple answer and JP could give a much better answer because I'm a dumb person, so maybe I might resonate with the dumber people here. Um, the way IV crushes work, a great example is earnings. Obviously, with earnings, you expect a really great movement or a big movement to happen. So the IV of the stock ramps up even more. And let's say, for example, Coca Cola, earnings is coming along and people expect this stock to move like uh, $4 after earnings, right? Which obviously, as you can see, Coca Cola doesn't gap up or gap down that much, right? But let's say the IV just ramps up from its current state of 16% all the way to like 25% or 24%. And let's say Coca-Cola only ends up moving like $1, and let's say you get calls and only gaps up like $1, because the move is so underwhelming compared to the IV, the contracts will deflate in price because it did not get the desired strength of a movement. um, when it comes to IV crushes. But JP, could you please answer this better? Because I'm sputtering out over here, it looks like.
Basically, IV crushes when implied volatility drops out of nowhere. And it normally happens after a major event, like earnings. And what happens is the value of options basically die incredibly quickly. Um, so essentially what happens is, like you stated, you have an implied move on an earnings call of 10%, and the IV's trading at 150, and the trade only moves 2%. And you're like, oh man, it's going to be up the next morning. Well, no, because the volatility of the stock just died, so therefore the premiums are going to get killed. Um, that's why whenever you take an earnings trade, if you're gonna take it, you almost need the implied move to take place. You only want to take earnings calls on high implied move earnings. Um, you know, Alta. Lululemon, uh, DocuSign, because when they go, they go. But when you're taking like a Coca-Cola earnings trade and it's expected to move 2% and it moves 1.5, it doesn't make sense. So IV Crush is nothing more than the volatility of a particular option because it's the volatility of a particular option dying because the underlying loses interest. That's all it is.
A really great example. Thank you, JP, for answering that. A really great example is not last NVIDIA earnings, but the NVIDIA earnings before that, where a lot of people bought NVIDIA calls, and I'm trying to. Is this no November 20th was the most recent one? Yeah, no, actually, even the last Nvidia calls, right? The last Nvidia earning, the past two Nvidia
Horrible.
earnings, the revenue was great, but since we have dumb investors, that's why I unfortunately I know people have Nvidia shares. I do want to retrace because if it retraces, at least we get some dumb investors out of it. But you could just see like Nvidia, for example, like Nvidia had two earnings where it did well, and the movements afterwards so subpar. Like they beat on earnings, they beat on revenue, and the stock went nowhere. Like it literally opened up at break even. So even though, like even people who bought puts, by the way, people who bought puts for Nvidia earnings, they did not profit off of this. Majority didn't. Is depending on what contracts you got, right? Majority did not profit off of this if they bought it on Tuesday, which was the day before or day of the earnings, and then sold it on Wednesday, the day after earnings. They didn't profit off that because the IV was so high, but the move was so underwhelming that the contracts literally deflated in price. It's similar to what happened to those guys who went in that submarine and they imploded and
Oh wow.
yeah, that kind of thing. So imagine that's what happens in earnings. If you don't get the move you want and it's very underwhelming, just imagine that submarine that went under the water and just imploded on itself and that tourism thing over there. But yeah, we're gonna get into the next questions. I'm not sure why I use that as an example. Would TSLL work? TSLL work in what? Oh, as a sympathy trade. Okay, let me see. That's actually a really good question. First of all,
Isn't TSLL
yeah,
the 2X
yeah,
on Tesla?
yeah, exactly. I was gonna say, and I'm pretty sure JP was gonna say it as well. Uh, you have to be very careful when you trade stocks that are times two shares, because I believe, correct me if I'm wrong, JP, if the stock even consolidates,
Oh, you're screwed. They die.
these die off as
Yeah,
well.
yeah,
So
they die. They die.
yeah, so yes, if you really think the move will happen, could this be a trade that brings you a lot of profit? Yeah, of course. The calls will go ballistic. But do keep in mind you want to probably size accordingly because if it does not, even if it consolidates, the contracts itself will die off because the ETF or whatever you want to call this, the times bull two times shares will die off as well. But to answer your question, let's see over here. So yes, theoretically, TSLL is a better sympathy trade than Tesla if you're bullish on Tesla, right? Or I guess if you're bearish, you could buy puts as well. Um, because the IV is below the halfway mark, right? You could kind of eyeball where the halfway mark is. You could say it's like right over here. But you could again see like the IV on TSLL, which is going to be the IV is always going to be high on two times shares because the movements are very strong. Um, but yes, theoretically, TSLL would be a better sympathy trade than both ARK and Tesla if you think Tesla will move up very strongly and very rapidly. So hopefully that answers your question. I don't know what volatility smile is. Do you know what that is, or is that just a misspell?
No clue.
Uh, this is a really great question. I'm really great you asked the Sky Blue. Will call spread or put spreads be a better choice when IV is high? So basically, they're asking. I guess you're asking about put credit spreads and call credit spreads. Um, yes, theoretically, whenever you sell options, the greatest thing you want is to be in a IV environment and trade to a low IV environment, right? Because without going too deep into buying and selling options and what the differences is, just think of it like this. Um, when you buy an option, you want IV to be high, right? So obviously, when you're buying it, someone has to be selling that contract, right? So the seller wants the opposite of what you're doing, right? So if you're selling an option, you want to be selling it. You want to be, at, you want to sell when it's high and buy when it's low. So the sellers, that's theoretically what you're doing when you're selling an option. Yes, you would benefit off of high IV markets or high IV stocks, similar to put credit spreads and call credit spreads, because when you sell options, theta and volatility is on your side. So if volatility decreases and you enter at a high volatility mark, yes, you do profit off of that a lot more in my experience versus a just a naked call or a naked put. So yes, hopefully that answers your question. Put credit spreads, call credit spreads. I personally find them a lot safer to utilize, especially if you want to take a gamble. And yes, earnings are a gamble. I don't care what you say. If you want to take a gamble on earnings, theoretically, uh, put and call credit spreads are better or safer because you limit your loss and you have IV crushes and theta on your side, right? So there's that. Um, but JP, oh wait, no, let me before I go on to the next one. The assumption then is that IV is not a concern for Leap since you have time, right? Really glad you asked that question. IV is still a factor even though you buy time. Let me see if I can show it here on the option chain. Let me go on to, let me do Apple. No, let me do NVIDIA actually, just because, actually, you know what, let me do Apple. Uh, I know Thinkorswim shows this. I don't know if Webull shows this. But for each option, for each expiration, maybe Webull shows this and I don't have the setting on. I'm not exactly sure. Uh, okay, I don't know. But for each expiration, there's actually different volatilities. So for example, obviously the week of expiration that you're on, so in this case it's December 13th, the implied volatility on these expirations are going to be are going to be bigger or more than the next week's, right? Because that's just the way it works. JP can explain that later. But IV still does matter for longer term leaps, and because sometimes the leaps might land on, earnings or something like that, or just if people are really bullish on a stock, because usually you buy leaps and their calls, right? If they're really bullish and you have a substantial amount of people buying one expiration, like for let's say a bunch of people are buying the 21 March calls for 2025, that IV, like the implied volatility on here, will be higher than let's say the February and January. So for example, for Nvidia, like January will be let's say like 28%, and February will be like 24%. But let's say there's just an unusual amount of buying contracts on March, this will be like 32%. So IV is still very relevant in leaps. And just like I said, even if you're day trading or if you're swing trading, you want to buy when the IV is low and then sell at a higher IV mark. So if I was buying leaps, because again we're not financial advisors, so I'll talk about what I would do. If I'm buying leaps with expirations that have lower IV marks, and of course does have okay amount of volume, right? Because I don't want to buy an illiquid contract. I'll buy a lower IV expiration because if the stock, like let's say Nvidia, moves my way, then my leap is going to gain significant amount of value because of course the movement of the stock price and the IV ramp up. So hopefully that answers your question. Um, so JP, so Steven posted this. This is apparently what volatile smile is. Does this ring a bell for you, or does this mean anything to you? Is this just you guys could chime in here in the chat if you know what volatility smile is. I've not. I I personally love
I've
learning new
I've
things.
never I've never heard this term. What?
I mean, maybe
Volatility
it's something
smile.
new that's come up because of the increased usage of platforms such as unusual whales and stuff like that. Option things.
I don't know.
But hey, I'm all about
Well,
learning.
I'm actually Googling
Yeah.
what is volatility smile?
Give me one second. I need to let my dog outside, so you
Volatility
could
smile is
do
a
that. Just give me
U-shaped
a second.
curve that shows how options implied volatility changes relative to strike. Oh, well, you learn something new every day. I had no idea what volatility smile was. I guess it's the U-shaped curve from strike to strike based on volatility. What is volatility smile? What is a tolerant option? What is a common share? Options, the same underlying saturation as the volatility smile. It's so named because it looks like a smile. Volatility rises when the underlying asset is further out. Out of the money, and converts out of the money. Yeah, it's volatility smile is the U shape of the underlying versus implied volatility on the options chain. Yeah, actually, I've never looked at that, to be honest.
Very sorry about that. I had to let my dog out. So JP, could you give me like a few second explanation of what smile is?
It's just a U shaped on the strike versus the strike price versus volatility.
Ah, gotcha. Okay.
Further out, higher implied volatility, closer to the money, less volatility, and forms a U shape.
Gotcha. Okay. Yeah, I'll definitely read more about that. I always love. I still believe, 11 years, JP even knows this, 20 years. There's still new things you learn every day. You got to keep your mind open
Yeah,
to it.
I've never heard of that before. It's yeah.
Thank you for bringing that up. Um,
Yeah.
but the next thing is would straddles benefit from IV being high? Uh, straddles. I always get confused because, again, I suck with terminology. I think straddles is where you buy contracts. Um, technically, technically, it's still the same thing because you want to buy at a low mark and then sell at a high point. So, yeah. I unfortunately can't answer this. JP, can you?
With response to what? What's a straddle?
Would straddles benefit from IV being high since you want a bigger move
Oh,
upward?
I have no. I mean, we're going into that's in-depth options knowledge
Yeah.
that I couldn't. I mean, I know what a straddle is. I don't play.
Wait,
Uh,
straddles where you buy calls on buy call and buy put,
my
right?
calls and my puts. Yeah,
Okay, so
I
then
don't.
yeah, go ahead. Sorry.
Yeah, I don't trade straddles. Or iron condors or butterflies or anything like that. I either buy calls or buy puts. I keep it simple. I keep it, you know, to the point. I mean, I do a couple of credit spreads, debit spreads or credit spreads, but I don't get into the complex options trading strategies. I don't have the kind of weight to do stuff like that.
Yeah. I mean, the answer is very simple. Uh, it's same theoretically. Like, if you want a big move, then if you really think a really big move is gonna happen, yes, of course, higher IV is going to be great for the short term if you're planning to hold it for a small amount. I mean, small amount of time. But if you're trying to hold it for a longer amount of time, then you do want, just as we said before, lower IV because once you start getting the move you want, the IV will increase, and you can profit off of whichever leg ends up being profitable. But yeah, so I guess there's a screenshot over here. Is this? I think this is Weevil. I'm not exactly sure, but yes, you could see as you could see each expiration has a different IV on it, right? So if you're buying leaps, I think it's very important. I would say it's very important to keep an eye on this because if you, depending on how risk adverse or risk what's the opposite term? JP?
That's good verse.
Risk adverse and what's the opposite term? Just risky?
Good question.
All right, so if you're risky or if you're risk adverse, If you're risky, of course, you could go for the high IVs, but if you're risk adverse, then probably best scenario would be trying to find a leap or a longer dated contract which has lower IV. So just in case that contract or that leap or that trade you're taking doesn't work out, you're not exposed to very extreme weather. Yeah. So is the IV same for call and a put? I feel sometimes calls goes for more for its same percentage move on QQQ0 DTE. Um, so each contract has its own different implied volatility. The marks that we show you or that was on the like for example the screenshot, right? You see this, like this is just the average IV, I believe. So each individual contract has actually its own IV, but it's not so far away from the average IV. I don't know the exact answer. Um, do you know?
No, I'm on the same page with you.
Yeah, I think. I mean, again, zero DTEs like most most contracts on zero DTEs are pretty similar. I'm very sorry. Just give me 1 second. I'm getting an important call. But JP, you could go with the other questions.
We'll wait for you so we can continue the streamline of the recording. Or I guess he just disappeared here. Another question might be around the idea that for clarity, if I buy a leap at lower volatility but closer to expiration, an event takes place that significantly increases IV, will that affect the profit margin even if at purchase IV was low? Why do I feel like I have to reread that question, Justin? Did did Kevin answer that? Or did he not? Justin, can you respond? Did Kevin answer that for you? Because I stepped away. So, an increase in IV is going to positively affect your profit potential, even if you bought the leaps when the IV was low. And this is because the options pricing responds to the changes in IV throughout the lifetime of the contract. Does that make any sense? Did I explain that in a simple way, or did I sound like an ass? Okay, you said that made sense. Okay. Does anyone have any other questions while Kevin comes back? Anyone?
Hey, I'm really sorry about that, guys. I have like, it seems like
Yeah, okay,
there's a
no,
glitch going on.
I just answered the last question.
Which one? The
Just
sky blue one?
yeah, no, if Justin buys a leap at lower volatility but closer to expiration, and that question,
Okay,
I just answered
gotcha.
that.
Okay, cool. Um, what was I gonna say? Another question might be as a high volume in general with small price spread might with high V. Well, volume with high price spread. I am so sorry, bro. You lost me. I have like two brain cells. Do you understand this question? What?
Uh, I thought you answered Sky Blue's question.
So
Let me read the answer. I'm sorry, read the question.
I'll read it out loud. Another question
Another
might.
question
Okay,
might
here we go.
be, okay, go ahead, go ahead.
Another question might be or not be related to IV is the price spread and contracts volume. As high volume in general with small price spread might with high IV, while low volume with high price spread and low IV, then how do we choose the option contracts? Oh, so you're talking about stocks that have low volume and bigger spreads?
No, I
Oh,
think what they're trying to say is
I thought I cracked the code for a second.
it
Contracts volume? So okay, wait, let me read
Yeah,
this
like
then.
volume, the volume, the bid, and the ask, and the IV all work together to affect your trade. That those all work together.
Gotcha.
But I think I'm trying to figure out what's the question.
So okay, are you basically asking if a contract with has high volume and a small spread, but it has high IV, versus a contract that has low volume with a bigger spread but has lower IV? Are you asking which is the better option? Yeah, you could
If
just
you
reply with yes, because if I crack that, okay, okay. So he's asking what the okay, JB, do you get that question when I explained it? If you okay,
no,
let's okay, JP. Let's say you have what's the stock Rivian, right? The one strike has 1,000 volume, and the spread is very tight, but the IV is very high. And then the strike below that has lower volume, the spread is bigger, but the IV is very low. Which contract would you prefer taking? Which one do you think is the better option? What they're trying to
oh,
ask.
high volume, tight spread, high IV, obviously,
Yeah, yeah. I think
because you're
it's
gonna
the
have
first
more.
one.
It's gonna be more liquid. The
Exactly.
opposite of that, you can have a low volume, low IV, wide spread. It's gonna be less liquid.
Yeah,
But then the thing is, when you have low volume, widespread, and low IV, those contracts with those wider spreads, if you can catch a good entry, those spreads start to ramp up.
that's
You know what?
correct.
McDonald's.
Huh?
McDonald's is a perfect example.
Oh, you want me to read
Less,
what's up in the chain? Okay.
it's a lower volume, it has a wide spread, it has a low IV, but when that thing starts to go, then it just gets nuts because those spreads take over, and those spreads are like 15 cents apart. So you can make a lot of money real fast. But I theoretically speaking,
Damn.
that that is a very risky trade unless you're catching a technical pattern where it's going to break out or break down and the market makers have to buy the equity to cover their options positions. Does that make sense?
Yeah, it does make perfect sense.
Sky Blue, does that make sense? Yes, no, maybe. Okay, perfect.
Okay, cool. And wow. And actually, JP, the crazy thing is McDonald's is one of those rare stocks which in a high IV environment has actually relatively low IV at 16.77% compared to its high IV high of 30%, which ties in why when McDonald's was moving for you when you had those calls, those contracts went up a lot. Um,
Yeah, 107%.
yeah, which contracts expirations did you get?
Um, Jesus, now you're gonna kill me. It
Hmm.
was no, that's Coca-Cola. These were the 310 calls for December 20th.
Yeah, so the fact that it was December 20th calls and it went to
Sorry, December
170%,
27th, December 27th, December
that
27th.
that makes it even more not crazier, but it makes it even a better example. This is a low volatile stock, a low IV stock. So once you get a strong movement for calls, which JP got into calls when you get in Wednesday or Thursday.
Oh boy, Thursday.
Yeah, so you could see here, Thursday is this candle, this is Friday. So in this much of a move, which by the way, I don't know how that made a smiley face, but this in a 2.79% stock move warranted how much percent?
It went up to 200%.
200%. So that's why IV, if you find a contract that has low IV, right? As you can see here, the gains you get afterwards because the price keeps moving and the volatility increase is very substantial. So thank you for reminding me about McDonald's because that is a really great example to showcase everything we actually just talked about. So thanks, JP. Um, okay, we're gonna wrap up a few questions and we'll go to the next topic because it's bridging on to 10:10 p.m. Um, maybe that high volume. Is there a place that you can check typical IV on a ticker at a certain time? No, not that I know of. If you guys do know one, feel free to let me know. But usually, for any stock, majority of stocks, IV always increases on Mondays, lower on Fridays, higher at open, lower during lunchtime, and increases during close. So the highest IV during the entire week is Monday, typically, right? Unless there's like some crazy thing that's on Friday, that's on Monday, that's gonna happen. So Friday's IV is high, right? So the highest IV is found on Monday open. Then when you go into an intraday basis, open is obviously gonna have the highest IV because people are buying and selling contracts. IV dies down around, I believe it's 11:30 a.m. Eastern. Average between 11:30 to 12. 12 to 1 p.m. you get low IV, and then IV increases at 1 p.m. to 2 p.m. to 30 p.m. and then from 3 p.m. to 4 p.m., which is close, you get the second highest IV of the day. Because remember, the highest IV is always going to be open. That's why I don't trade open. And Sky Blue made a joke saying that's why Kevin skips Mondays. Yes, because that's why Mondays statistically have the highest IV in contracts. And even if I want to take a day trade, I have theta and high IV working against me. So why even do that, right? Why not let the market pick its sentiment? Whatever. That's a whole nother spiel for another day. But so Mondays have the highest IVs. Wednesdays, I believe, have the lowest IV. Fridays have the third lowest. So Fridays, that's why I actually still swing over the weekend, because sometimes if you get at a low IV mark on Friday, because Monday is a naturally high IV day, the contracts get inflated. So if the stock goes a little bit in your way, you might actually be propelled to like already 10 or 20%. So that's why I still swing over the weekend, because if you see something great, yes, you do have the days of theta working against you over the weekend, like Saturday and Sunday, but the high IV mark on Monday is great if you swung from Friday, theoretically on a typical Friday, right? So hopefully that answers your question. Do you have a preference of weekly contracts or monthly contracts? Day trades, of course, I always trade weekly. Monthly contracts, if I'm trading a swing with that I feel has a lot of more room, then I'm gonna go with monthly. Uh, I usually choose 2 to 3 weeks out. JP, what are your thoughts on
45.
that? Huh?
I like to go 45 days out.
JP's old school, which is not
I
wrong.
like to go 45 days out, 3 months out.
Yeah.
Sometimes I go 6 months out. I have no problem doing that. But if I'm looking for day trades or like a couple of swings, like because I like okay, timeout. Let me answer this correctly. If I'm getting into a trade that I know has momentum and that I feel comfortable for holding more than a week, I'll normally take 45 days out or even through 45 to 3 months out. If I see a trade that has momentum, I think it's going to break out and could retrace, but I want to catch the momentum and I think I can hold it for 2 days. I like to look 3 weeks out. I don't like trading weeklies at all. I don't like trading zero DTEs. And I even get scared when I trade 10 to 10 days to 14 days out. I really like that 21-day mark. Like that's my sweet spot. That's my sweet spot for like a 1 to 2 day hold. But for like over a week, 45 days.
Oh, JP likes time. I remember sometimes when we were looking at a trade, This guy would tell me about a contract that's like a month and a half out. I'll be like, oh my god, JP, that's too much time. But hey, that's why JP's trades are more consistent. Yeah, I'm consistent, but he's more consistently green because his contracts allow him to have a safer safety net, allows time to work. Time is on his, technically kind of on his side, and even his losses are actually very small because even if the stock gets invalidated or the setup gets invalidated, the theta is not a high, or is not high, and IV, as we said, right, the farther you go out, typically the IV is going to get lower and lower. So the IV is also not working out against him so much. So that's why a lot of JP's trades are more consistent, and his losses are very small. So,
Well,
yeah,
I'm going to give you a perfect example.
what's that?
Listen,
Mm.
I took those Nike weeklies
Oh
that we got
God.
collapsed on,
Yep.
and
Yeah.
I wasn't very happy about that. I was not very happy about that because if I would have taken 2 weeks out, I probably would have still been in the
We
trade.
would have been green. We would have been green on
Yep.
Friday. I mean, look, it reached
Yep.
81.29. I was so pissed off that day at the fact that I got weeklies. And
Yeah,
like
I
people,
know. I don't
mm,
understand why you took weeklies, and I'm being dead honest with you. I don't understand what you even put on your trade idea. You said this is a risky trade, and I was like, you know what? I kind of want to
what
play with fire, man. But
what
it.
day did I take them? Monday? Let me
What do you
see.
mean?
What day? Let me see what day I took the Nike trade.
I think it was Tuesday.
Tuesday. Let me see. 1 second. I actually want to figure this out. So I got them on. Whoops. There we go. I got them on Monday. Yeah,
Wow.
I got them on Monday. You know why, JP? It was a dumb move on my end. I'm like, okay, this is a really great because I'll show you what I saw on Nike.
No, I know. I have the same data set up. I don't want to talk about it. I
Yeah.
don't want to talk about it.
So, hey, I
I'll be
mean,
right, Kevin. I'll be right back.
yeah, go ahead. This ties into why I'm such a high advocate of buying time on my contracts, is because, again, I don't talk highly of myself, but I use myself as an example because you won't see people trading with the stats that I have, right? Other else than consistency, because win rate is one thing, right? Win rate, of course, you could have great win rate, whatever, but win rate doesn't matter the most. It's always the average option trade, because a person could have literally a 70% win rate, but if their losses are bigger than their wins, then they're never going to really be long-term profitable, right? Maybe in a lucky season, but that's it. But if your average option trade is significantly high, right, and this stat calculates my losses and my wins. So if it's higher, then your account theoretically will keep growing, right? Like even if I remove these losses really quickly, you could see, like if I didn't have these losses, whoops, I would be at a way higher mark. I would be at 146 for the past week. But of course, I'm human, so mistakes happen. But you go back to November, right? 140%. October, 168%. Uh, September, 121. These are obviously not small months, right? In September, we had 52 trades. October, my best month, we had 95 trades, and my average option trade was 168%. 62 trades, 140. Why am I showing you this? It's not to gloat. Again, I'm not a person who gloats. The reason I'm showing you this is because there's a common factor or a common reason why my trades are so highly percentaged is because I allow myself to be in great positions where I buy time on my contracts, whether it be, I don't do 45 days out like JP, even though that is safer because I am a riskier trader than JP. I do take usually 21 above like 21, so like 2 to 3 weeks out. I can hold these contracts. I let the move work out, and these contracts go ballistic, because as I said, the IV increases if the move increases, right? So if I have a farther away expiration, and naturally the IV is low on that farther away expiration, Sorry, I had to drink a sip of water. If the natural IV is lower on a farther away expiration, my contract gets propelled by that. And also, when you everybody can agree to this. I don't care what you say. You have to agree to this. When you buy weekly contracts, nobody's dumb, so they have the fear of theta, meaning your trade will be up 100%. And you're like, oh, I've runners. I could leave runners, but I'm so scared about this profit being lost because of theta. If it just consolidates tomorrow and then it chews the gap up the next day, yeah, it could be green the day after that, but I'm really gonna lose money on my runners for tomorrow. So let me get out, and you get out, and then let's say it actually ends up going your way the next day. Like, why would you want to be in that position? Why would you want to just, you have a great setup and you didn't allow yourself to have time because you're so degenerate, like I was on Monday for Nike, that I, chose to go with weekly contracts instead of my usual 2 to 3 weeks out, where I was so enticed by the fact that, hey, I could make actually a decent amount of percentage on Nike. This is my exact thoughts. JP asked why I got it. Because I'm like, oh, this is a really great setup. Let me get it. Same weeks, very cheap. I could get 100%. But if I got 2 weeks out or 3 weeks out like I usually do, not only would that not be a loss, I would be up, and I would be able to hold this trade, and I'll be able to hold my runners a lot longer than I would have if I held a weekly. So a lot of people ask where I get my skill of holding on contract for so long and having all these insane runners and these very big trades, is because I have given myself the good habit of learning how to hold. And I keep on saying this over and over again. You want to put yourself in situations where you learn good habits and not bad habits when it comes to trading. Meaning, zero DTEs are never gonna, they're gonna give you only a very small handful of good habits to learn. You are only gonna learn bad habits when you learn zero DTEs. You're gonna only learn how to overtrade. You're gonna learn how to oversize. You're gonna learn how to be you could actually both ways. You could learn how to be greedy, and you could actually learn how to be a paper hander, or whatever the correct word is. Right? I don't know. I'm blanking out. But when you give time for your trades, you're forcing yourself to be patient, because the dumb times where you exit early, you'll think to yourself, "Oh damn, I had time on my contracts. I just wasn't patient enough. I gotta wait for my trades to work out." So that's a lesson learned for next time, right? If you take a weekly contract for a swing, if you exit out and ends up going your way still, you're not thinking, "Oh, I still had time." You're thinking, "Nah, I'm an idiot. I should have held it." So you're only learning one lesson. Versus if you had time, you're learning, "Hey, I should have held it if the setup is still there." And hey, I had time. That would have worked out for me really well. So put yourself in situations where you're gonna learn and have a learning curve and actually grow wealth, instead of putting yourself in situations where you're just trying to become rich, because wealth significantly outlasts being rich. Um, but yeah, that's a rant from an Indian kid who's 23 years old. All right, so I skipped my last question. Which question did I skip? High IV is related to the expectation of the direction that the stock is going. If there is high IV in calls on a stock, can we assume that the puts at that instant have low IV since it's not expected to? No, because even there's no such thing as a guaranteed stock that'll go up. So as much as there are people who think it's going to go up, there's almost an equal amount of people who think it's going to go down, right? That's the law of physics, right? There's always an equal force. And of course in trading there's not always going to be exactly an equal force, but if there's a strong movement that's predicted to happen, it doesn't matter if the strong movement is predicted to go up, because again, this ties into Nvidia. Why do I not like where Nvidia is at and how it's trading? Is because just look at the fact of how the earnings are playing out. People are bullish on Nvidia, right? Nvidia is a great ass company. You expect it to be growing in the long term, but the expectations are so high, and it's going to be bullish. And it was so bullish the last earnings. You don't understand. The last Nvidia earnings was amazing. But because even though everybody expected it to go up and the IV and the calls were so high, because there were so many dumb investors involved in Nvidia, because they didn't get the rub off that they wanted in the Nvidia earnings or whatever they thought, the contracts got crushed, right? So, and Nvidia ended up going down. So that's why even though IVs, it's not just high IVs on calls and then low IV on puts. It might be a little bit higher on calls, but the IV is also somewhat closer on puts because if there's a reaction expected on a stock, even if it's bullish, there's theoretically an equal expected reaction to the opposite side. So hopefully that answers your question. Um, how do you take trims on options? Can you please tell in percentage, if not numbers? I sold crowd options at 30%. Um, Unfortunately, since this is not about that, and I do want to move on to the next topic, the greatest source I could say you can look at is the How I Trade document, which might be, I think this might be in, no, it's not. So let me actually put it in the resources channel because this is a really good question. So let me copy link. Okay. So if you go to the resources, I posted a link there. There's a document called How I Trade, some I bought all the time for every single post. You could see how I trim, the way I set my limit orders. There's transparency there, and I give situations, so that should theoretically answer how I take trims on options. And just because I don't want to spend time talking about that right now. But I think that's a wrap for IV, and we can move on for fib extensions. Is there anything else you want to add, JP, before I move on?
To answer the question of where you take trims, wherever you feel comfortable with. There is no right or wrong answer. If you feel comfortable at 10%, take it. If you feel comfortable at 50%, take it. It's all up to you. I use level to level trading and I wait for my levels to hit, but I normally will take trims as soon as I start to see profitability hit. And I like trimming at around 20-25%, but if I see that the trade's continuing to go, I'll just let it go.
I'm actually really glad you answered that because that reminded me we technically did somewhat talk about that actually in the last live session.
Who accepts the
Yeah,
rules? You only
that's why I brought it up.
Yeah, so, and that video, by the way, is exiting trades for loss because, yes, exiting trades for loss does tie in with, how you trim your position, right? Because you can't think about your winners until you think about what you're going to do with your losers. Uh,
Yep.
in our resources, I posted a thing I typed out a long time ago and I posted it here now. I think it's a great thing for people to look at just to gain perspective about how they want to plan out their risk strategy and their risk plan because you can't really trade successfully without having a risk management strategy. So that ties in with dealing with winners and losers because both are very crucially important. You can't succeed if you lack in one. So you need to learn how to do well in both. So go check the resources channel. It's again in right here, absolutely free. Read this. Maybe you might think about it. Maybe you don't. I bet most of you don't think about it. So read this, figure it out, and then watch the how I trade. Not how I trade. The exiting trades for a loss video. Um,
Please follow our YouTube video. We have a lot of stuff you guys can watch there. And all of our sessions are recorded.
yes, that's correct. So definitely check out our YouTube. Uh, we have content going all the way back till 2 years ago. Because
Yep.
I used to do live session before JP. Unfortunately, it was a very boring time, but yeah,
Back in the day.
yeah. All right, we're gonna move on to the next one. So let me stop this recording and hopefully it works properly.